Finance leases and equipment loans. We are often asked by clients to explain the difference between an equipment loan or a chattel mortgage and a finance lease, and their subsequent treatment for taxation and GST. So what is a finance lease? Under a finance lease, the asset is rented to you for a fixed period, usually 2 to 5 years. The residual value is set at the start of the lease to reflect the asset's value at the end of the lease period. At the end of the lease, you can return the equipment and pay off any difference between the residual value and the market price, or purchase the equipment for a predetermined residual value. The main advantage of a lease is to preserve your cash flow, as you can acquire the asset without an initial cash outlay. The repayments are usually lower than loan repayments, as you are only paying for a percentage of the asset's full value. You will also have the flexibility to update the asset every few years. Under a lease, the lessor retains ownership, so assets cannot be modified. There is a very real possibility that at the end of the lease, the predetermined residual value that was set when the lease was established may actually be less than market value. A lease is a long-term obligation and is difficult to cancel without incurring penalties. Lease payments are claimable as a tax deduction based on the percentage of business use, and you can claim the GST on lease payments based on the percentage of business use. What is an equipment loan? A chattel mortgage or loan is essentially a mortgage over the asset that is to be financed. The asset becomes your property at the time of the purchase, and the financier takes a mortgage over the asset as security for the loan by registering their interest over it with the PPSR, the Personal Property Security Register. Under a loan, you will take ownership of the asset at the time of purchase and can therefore carry out modifications. Contract terms are flexible, and a residual value or a balloon payment can be applied to the loan, which will reduce the monthly repayments. Interest rates are fixed at the start of the loan, so all costs are known in advance. A tax deduction is available for depreciation and loan interest payments based on the percentage of business use. With a loan, your monthly repayments will be higher than leasing payments, depending on any deposit you have paid and the value of the balloon payment. You will usually be required to make upfront deposit when purchasing an asset. As mentioned previously, depreciation and interest repayments on a loan or chattel mortgage are tax deductible based on the percentage of business use. These deductions are higher at the start and reduced over the term of the loan and useful life of the asset. Where the purchaser is registered for GST, the GST contained in the price of the asset can be claimed in the period the tax invoice is received, depending on the percentage of business use. Thank you for watching Lease First Loan. If you have any questions or would like any advice specific to your situation, please do not hesitate to contact the team at The Money Edge on 0741 518898.